Each year, we undertake a comprehensive review of our 5-year outlook, culminating in investment themes and asset class forecasts that underpin our portfolio construction process. We expect market returns to drift modestly below long-term historical averages, with stocks lagging through a sputtering global economy and bonds capped by flatter global yield curves. In forming this outlook, we have identified 6 key investment themes. Let's explore 3 of those themes here. No economic variables change more rapidly or created more volatility for investors over the past year than inflation, leading to inflation recalibration. Just as investors thought inflation caused by pandemic-related supply disruptions would eventually settle down, the war in Ukraine triggered soaring commodity prices and forced investors to recalibrate their inflation assumptions. Automation and digitization still produce powerful disinflationary forces, but these forces need some time to overcome the shocks of stressed global supply chains, tight commodity markets, and depressed labor supply. While inflation may take years to return to normal, we believe the worst has passed. To fight inflation, central banks have decisively shifted their focus from supporting economic growth to increasing interest rates to slow spending. This has created a monetary drought of tight financial conditions. Investors must adjust for higher interest rates when making investment decisions and can no longer depend on central banks to come to the rescue if the economy falters. We expect the Federal Reserve to boost its policy rate from 2.5% to a peak of 3.25% and then reduce the rate slowly afterwards while inflation fades. As the final theme we discuss here, globalization is evolving into regional building blocks. Countries are rebuilding their economic and military security by limiting their dependence on imports such as energy and technology, especially from political adversaries. The war between Ukraine and Russia highlights this trend. Europe is scrambling to revive homegrown energy sources after Russia significantly cut its natural gas exports to the region in response to severe sanctions from Europe and the US. While deglobalization may move slowly, we think investors will decide more quickly on whether or how best to deglobalize their investment portfolios accordingly. We think these themes and other market forces translate into below-average stock and bond returns in the coming years. For stocks, lower valuations may provide some support, but higher interest rates likely cap how high valuations can go. Further, historically high corporate profit margins face deterioration with inflation and a slowing economy. With emerging market equities, China's low COVID-19 vaccine effectiveness makes more outbreaks likely, while the country's zero-COVID strategy has left its economy vulnerable to a slowdown. We believe emerging market performance will fall below the long-term average of the past 2 decades, but somewhat higher than the last 5 difficult years. We see bond performance, aided by higher yields, bouncing back some from historically high losses, but still we expect modest performance. Flat global yield curves likely mean more dependence on coupon payments and little support from price appreciation. We believe high-yield bonds will benefit from wider credit spreads amid stable fundamentals. Inflation recalibration will likely put some pressure on profit margins, but we think high yields, improved quality mix, and a maturity schedule with a long runway should keep the default rate at or even modestly below long-term averages. Our 5-year forecast call for a 5.1% annualized return for a portfolio invested 60% in global equities and 40% in U.S. investment-grade bonds versus the 5.3% annual return realized over the past 5 years. We think investors have reason to expect some more stability as high inflation slowly fades, but they should prepare to navigate through a potentially difficult global economy and political uncertainty. To get our full set of forecasts and insights across asset classes, download our 5-year outlook at capitalmarketassumptions.com.